So again, happy Friday, everyone. Great to see you all. Thank you for taking time away from your no doubt busy schedule as one of the world's best COOs. And I know how difficult the job is. So again, thank you for taking time out to work on yourself today. I'm excited to have Channing Hamlet here. What makes it special is Channing is director at one of our member companies, Mandy Woods. Thanks to Mandy for having Channing on. And I will also extend an offer out to all of you if your company has some unique insights that you'd love to share with the COO Forum. We'd love to open the doors to that in 2026. So without further ado, I guess, let's introduce Channing Hamlet, presenting today on getting exit ready and the COO's playbook on maximizing company value. I know from my own personal experience that I've worked with companies and owners that said they would never sell, and then a month later, we're doing due diligence. How the heck did that happen? And so it kind of can creep up on you. There's an old adage that says the next thing you should do after starting a business is to figure out how you're going to get out of that business or exit that business. So in all of the entrepreneurial's life cycle, there's a time to consider exiting the business. COOs play a very intrinsic role in helping maximize company valuations. And so I think today's topic is spot on for many of us. A little bit about Channing, and I hope I don't butcher this too bad. You might have to fill in any blanks I leave out, but Channing is managing director and co-founder of Objective Investment Banking and Valuation, a nationally recognized firm serving middle market companies with M&A advisory and valuation services. He's been an active member of the Los Angeles advisor and founder ecosystems. He's been on the board of Exit Planning Institute and the Association of Corporate Growth in Los Angeles. Also, he's a member of EO Los Angeles, a frequent speaker and a thought leader. We're so excited to have him. And like me, Channing is a mechanical engineer by training. So I'm curious to see how he got into this current role in life, but we'll leave that up to Channing. So if you would, please be on camera if possible. Let's make this an interactive session and make sure you get the most out of it today. And with that, I'm done talking for the next 60 minutes or so. Channing, all yours.
Oh, thanks for having me. I think, Chuck, I might invite you to my next speaking engagement and have you introduce me. That was nice. Thank you.
All right, I'm on.
I was thinking about this talk and really want to be here and educate and answer your questions. And I did put some slides together, but it's not an hour of content. So I'm hoping this can be really interactive so we get the answers to your questions. And I was thinking in the COO role, and Mandy and I talked about this a little bit as we were preparing for this. In the COO role, how can you help, and what's in it for you? And I think there's sort of a couple thoughts just out of the gate. In the 30 years I've been working on transactions, almost all of my work has been with founder, entrepreneur, family-owned companies, not private equity or institutionally owned. It's been private companies, I think, like most of you. And in almost every case when I've worked with a client and helped them sell their company, there's one or more ways they left money on the table by showing up unprepared or not understanding the process. And it's a very complex and nuanced process. And so I think as a COO or an executive, working for an entrepreneur, founder, whatever, bringing some tools to them to help them have a more successful exit, will help them. And, a lot of us love helping other people. And so that's one of them. And then I think the second one is, to the extent that we can have a successful exit, or be part of it or help a company get there, that's a great resume builder for the next opportunity. So I just want to give all of you some, tools and thoughts that you can bring back to your company to be helpful. And, I think a lot of times, like, running the day-to-day of the business is one thing, and, building the business to be sold, there's a different thought process. And so one of my first 6 years of working was doing investment banking, mostly helping business owners sell their companies. I wound up involved in about 25 sale transactions. And I think the average deal I worked on was probably 70 or 80 million in value. And then after 6 years of doing that, I had an opportunity to go work at a private equity firm. And so I sat on the other side of the table, and we invested in and bought companies. And one of the things that the firm that I worked for was a first-time fund. The two partners that I worked for had raised $250 million to invest, and we invested in about 25 companies. And that fund tripled. We tripled our money, and we returned $750 million to investors. It was fairly successful, and there were a couple things that we did, I think, that were really interesting. One of the things is when we first made an investment in a company, we would go sit down with the management team and talk to them about, hey, look, we invested, you guys own some of this, we own it. We're in this to build the value of our investment. Let's talk about what we're building over the next 3 years, 5 years, 7 years. Let's talk about what we're building. And usually we would leave that first meeting with a list of 5 to 7, like, kind of key value drivers and key initiatives that we were working on. And then we would ask the company to report on those every month. And so every single company we invested in had a report in some way, shape, or form that we went over monthly, and that the board meetings and that we worked on, that was designed to build the value of our investment. And, I told you the results. Like, that was one of the, investing in good companies, good management team, good markets, and like all that other stuff matters. But like, really having a focused playbook for the companies was important. And so I have yet to go to one of our clients that's thinking about selling and having them say, oh, here are my 5 or 7 value drivers that I work on every month to build the value of my business and make money for my shareholders. I've yet to see a private company do that. And so if there's like a single thing that I could leave you all with, it's to have the discussion with your owners and with your executive team and so on and so forth, beyond just like, hey, we're trying to make payroll next week, or we're trying to hit our budget this year. Have the discussion about what is it we're building here, and what are the key initiatives we need to work on, and let's measure and manage them. Most companies, in my experience, haven't really, they talk about it, but they haven't really explicitly and formally done it. And, as a group of COOs, like, I think that's something that just that one thing, if you take nothing else from this talk, just that one thing could make a massive difference in changing the trajectory of the company and creating an exit for your founder. So I have some slides that I'm going to bring up. Oh, Connie, you have a question.
Can you give me an example of the key metric drivers? Obviously revenue, COGS, right? Anything that stands out as like the absolute staples besides the obvious from the
Yeah, I guess you don't really need me to show up and tell you that, like, EBITDA, like growing your EBITDA is a value driver. That's kind of a obvious one. I think we tended to spend a lot of time thinking about like leading indicators that would create revenue growth or create EBITDA or whatever. And, every company is different, and every industry is different. Every company is different. Every industry is different. And so there can be like very different value drivers. For example, if you have a chain of retail stores, one of the big value drivers is having a proven model. It takes us X months and Y dollars to open a store. and then it takes us Z months to get to break even. And at the end of year 2, this is the performance, and we get this ROI on our store. And so we invested in a chain of retail stores, and we worked with the management team to prove out the model. And we wanted to open 10 stores that hit the budget. And that was a value driver. And we had like, how many stores did we open this year? How many of them hit our plan? How many didn't, and why? And what did we learn from that? And so when we sold that business, we were able to sit down with a buyer, and it's like, there is a proven formula to grow this business. We open a location that looks like this, it performs like this, and we do it consistently because we've figured out how to do that. So as a buyer, all you have to do is show up, and with your money and resources, just turn the crank faster. And so like really thinking out of the box. And I have a whole slide on that's meant to like prompt thinking about value drivers, but that's one that, that's one that comes to mind. Another one is early in my career, and this probably dates me quite a bit, but I think it's a good story. I worked with a company that was in the security alarm industry, and they were buying companies. And what they were doing is, when they looked at a company, they didn't care what the profitability was. All they cared about is, what does it cost you to get a new client, a new customer? How long do you keep the customer? And how many customers do you add each month? And so when we were looking at helping them buy security alarm companies, we didn't really care if the company was profitable or not. Like literally, we didn't care if the company was profitable or not, because we knew we were buying a group of accounts that we were going to put on our system, and we knew how much money we would make from that. And so if we looked at 2 security alarm companies, and one was like very profitable, provided great customer service, but wasn't growing, and then the other was like rapidly growing, but not necessarily well run or profitable, but they had some good client metrics. The not profitable, poorly managed, like losing money company was actually worth more to us, because we could make more money off of that by bringing in like operational support. And so really being aware of your business, industry, what drives value, and what you're trying to build and why, can be like pretty counterintuitive, and it's sort of nuanced and custom for each company.
That's great. Thank you.
Chris is asking a question. I think in the chat, Chris is saying necessary to have formal framework like OKRs and track these, or simply having a strategy and consistent cadence of review sufficient. I think both. I think having some formal metrics that are tracked is important, but not losing sight of some strategic initiatives as well. And I think, to me, like I like to simplify things. Like I like to pick like 3 to 5 things with the companies I work with. Because I think if you try to do everything, you do nothing. And so I think it's easy for a management team to track a dashboard with like tons of different metrics and all that stuff, but then like the big ones get lost. So having a separate, value driving framework, dashboard, whatever you call it, with 3 to 5 things, or whatever they are, can really make a difference. All right.
If you would, James Beck had a question for you as well.
Actually, I was just typing it up just real quick. Is to answer that question, I'm in the venture world, and what we have found the best way to do that is you just call up an investment banker. And so, using your example of retail, right, revenue per square foot sometimes is a very key metric.
Yeah.
So you just call up the investment bankers and ask them what the investors are really honing in on in today's world, and they'll give you a list of 5 or 10 KPIs for your company that's in that sector. This is in addition to what you just mentioned, which is the buyer may have specific objectives, right? They're looking for a profile of a company, but the KPIs, the quickest, best way to do that is like the security business, right? Some people don't like churn, right? As you mentioned, high customer satisfaction, low churn, that could be very attractive. And so you ask what the market's seeking, because it changes and evolves. And so anyway, that's what we do every 6 to 12 months. And then we try to track those. We have across our portfolio, we track those for each of the companies specifically, and then monitor them.
Yeah, that's actually, I think there are a lot of outside resources that can be helpful. One of the other things is buyers are frequently calling companies wanting to buy them. And so selectively having those conversations and understanding what the actual buyers are looking for can be helpful. Investment bankers will do a ton of free work for you if you're nice to them, and so there's definitely there are formal consultants, you can hire valuation firm, and there's a lot of resources to figure this stuff out. Okay, so you guys can see my slides. Cool. I consider this a success at this point. I got the slides to work. I guess, there's not a lot here, but I wanted to talk about, I have a case study, and then I wanted to talk about just some like conceptual things to think about, value drivers and value detractors. And there's a sort of framework and some brainstorming that we can do. And then at the end, talk a little bit about what a good sale process looks like. Let's see. Okay. So I did this when I did this already. I think the other one is 100% of business owners will exit their business at some point. The only question is how. And like, I always kind of think of it as like, there's a number of different Ds that can happen. Distress, death, disability, divorce, or by design. And so, having this plan, like I talked about earlier, can make, a really big difference in being ready. It makes the business easier to run. And if something happens, good or bad, you're ready. And so we worked with this company called Bell Canyon, and their customers were large and mid-sized pharmaceutical companies that were managing CRM data. And in the pharmaceutical industry, there's some really complicated regulatory reporting around how many samples you gave out and stuff like that. So Bell Canyon was doing this CRM data management. In 2015, their owner was called by a competitor that wanted to buy them. They shared some information with that competitor, and they had an offer that was some cash and then a combination of earnouts and future payments. And so I'm at the CEO when they had this offer, and there were 3 partners that owned the business. They weren't really aligned on what they wanted, and they were kind of all frustrated with each other, and they were sort of considering taking this offer because it was like the easy button to unwind like a complicated relationship. And I started asking him some questions like, do you close your financial statements on a monthly basis? And he's like, what does that mean? And, do you do GAAP financials or cash basis accounting? Like, looked at me like a deer in headlights. Do you have a management succession plan? He's like, no, I run sales. My other partner runs operations, and my third partner runs technology. If one of us gets hit by a bus, like, I don't know what we would do because we're all critical to the business. And then it's like, well, do you have any, do you do budgeting? No, we have like 3 large customers that, we don't really know what they're going to do with us next year. Do you, like, everything I asked, the answer was like, I don't understand the question, or no. I mean, they were like a case study in how not to be ready to sell the company. And so over the next 3 years, we helped them design a roadmap. To strengthen their systems, structure, and value drivers. And 3 years later, they had each of the departments had a manager that was designated as a successor. They hired an accounting firm to clean up their financial statements and had a really comprehensive monthly reporting package, audited financial statements. They had gone to their customers and signed long-term contracts with recurring revenue. And so like, if you talk to a private equity firm or a buyer and you ask them like, oh, hey, what are you looking for? You know, consistent revenue, management succession, clean financials, growing business, high margins. Like they literally like check, they won the private equity bingo game, as I would say. Like they checked every box. In 3 years, they more than tripled the value of their company, and they got an all cash deal as a result of putting this whole plan together. And it was a good thing they did all this work, because one of the 3 founders, who was the key salesperson, had been diagnosed with cancer, and they needed to sell the business. So had they not done this work, they would have sold the business for, you know, well, they may not have been able to sell the business if they had not done this work, because their key salesperson was exiting the business and he held the key relationships with all the customers. They did this work, they built a sales team, and they built all these repeatable systems. And so when we sold the company, Kevin, the key salesperson, was not necessary to go work for the buyer, and they were able to get this like really good deal. So by doing this plan and really putting the work in to make their company saleable, they really created something special, and it had nothing to do with like making money. It created a great outcome for all the employees, all the families, and everybody. And so this planning can really make a difference. There's a case study here. We had Kevin come in the office, and if you look carefully at this picture, he had gotten in like a fight at a rally the night before and had a black eye, and Cheney, who's on the call, had put some like makeup on to hide it. But he does a nice sort of talk about his experience of prepping for exit. And so when we send the copy out afterwards, I'd encourage you guys to look at that one. Let's see. Okay, so how do I get the page to go? You know, I think when I am introduced to companies, when I'm introduced to companies, like, I think there's just a lot of issues, just basic issues that are facing business owners that are thinking about a transaction. You know, on the personal side, they don't understand, quote unquote, their number. You know, that they own a company that pays them, and they're thinking about trading that for cash, and they don't know how much cash they need to replace their income. They've done no work on understanding what the value of their business is. They don't understand the taxes. Like it doesn't really matter what you sell your company for. It matters what you sell your company for after tax. They've put no thought into what they want for their life, and they haven't talked to their family about how it's going to impact their family. And then on the business side, on the business side, they haven't really done the value drivers and detractors. There's not really an investment in reporting systems and budgeting and forecasting. You know, they haven't really built a management team that a buyer is going to be confident in. They don't have a written strategic plan, and a forecast won't survive a buyer's due diligence process. And so most of the companies that come to us that want to sell their company have, you know, many of these issues. And so I put this together to really think about, and, you know, I would encourage all of you to have this type of discussion, you know, with your ownership group, and just help them think it through. There's like 4 separate things in my mind that it takes to have a successful exit. I think the first one is the personal objectives and legacy. And in the chat, we were, one of the questions was about some of the emotional sides of a sale. And I wrote back, like, when you figure that out, let me know. This personal objectives, legacy, what's next? What does it mean for my family members, my customers, my employees, my key stakeholders? Like, how do I really like get my mind around the fact that I, as an owner, I'm not going to be the owner anymore. I'm going to be doing something else. That's not something that is easy to figure out on a Friday afternoon over a beer. It takes, real thought and effort. And so one of the companies we worked with, the owner had tried to sell his company a couple times and, got cold feet at the end and walked away. And he ultimately hired a therapist and spent like 3 years working with the therapist, like figuring out that his identity was separate from the identity of the company, and figuring out what he wanted. And ultimately that led to him getting comfortable, putting new management in place and doing some of these things. And so this personal objectives and legacy thing is really interesting. I see that Chuck has his hand raised.
Yeah, question for you, Channing. So I've been a part of a deal where when we sold, the owner of the company stayed on for, it was supposed to be 2 years as part of an earnout. And he managed to get himself basically ejected after 7 months. And going back to the kind of the personal trauma that happens when you invite someone in to totally rearrange the living room in the house that you've built for 30 years, he just couldn't adapt. So I guess through all of that, my question is, how successful are earnouts with the ownership teams? Or do they tend to be successful if they stick around, or would you advise owners to exit the business at sell? What are some thoughts?
Yeah, I mean there's a lot to that question, and I think you have to really sort of step back and understand the owner's objectives, and then if the earnout matches those objectives, then take the risk. If it doesn't match those objectives, walk away. We had a client that we worked with, and we signed a letter of intent to sell his company on March 12th, 2020. That was Thursday. For those of you that are paying attention, that was Thursday. And I had a conversation with him. He's like, I've got my house in Costa Rica picked out. My wife and I are going to move there, and I am going to surf for the rest of my life. This is more money than I ever thought I would have. And my life, I'm going to live my life by design. This is incredible. His business sold noise attenuation products that went in offices. Like if you go to the new open concept offices and you look at the baffles on the ceiling and the panels on the wall and all that stuff, he was selling those. He had like Facebook, Google, Amazon. I mean, he was killing it. And then on March 13th, the day after we signed the LOI, people stopped going to the office. And so 2 weeks, so it was like, all right, the office is going to be shut down for 2 weeks. Like we talked to the buyer, like, hey, offices are going to be shut down for 2 weeks. In 2 weeks, let's reconnect and we'll get this deal back on track. And we all know what happened. Long story short, the business went from growing and profitable to about a 70% decline in revenue and losing money. Then the owner had some health issues and couldn't work in the business and was forced to sell it. And so we went back to the same buyer maybe 18 months later and were able to get the same overall price for the company, but it was like a quarter of it was in cash at close and 3/4 of it were an earnout. And so the owner is like, look, I've got health issues. My business is a train wreck. I don't know what's going to happen to offices going forward. My choices are to take this deal, which is not a great deal, but has potential. If the world recovers, it has potential for me to get what I otherwise would have gotten. And if the world doesn't recover, I no longer have this mess on my hands of trying to like pivot my business into a new market that I'm not even sure what to do with. And so in his case, the decision framework was clear. Like, I could own the business, and if the market recovers, it'll be worth what this deal is worth. And if the market doesn't recover, it won't be worth much. If I sell the company on this structure and the market recovers, I'll get a fair price. And if it doesn't, at least I got something. And so he accepted the deal. And over the next 2 years, the market recovered and his business recovered, and he wound up being paid the full earnout. And so, like, there are examples where an earnout makes sense and it can work. And, you know, there are plenty of examples where an earnout doesn't make sense and doesn't work. And so I don't think there's like it's easy to sit here and say, look, the standard advice is don't take an earnout, because like they usually like half of them get paid and 90% of them end in litigation, and like, don't do it. It's easy to give that standard advice, but it's really much more nuanced, and you got to look at the details.
Yeah, I think in this situation, it was more so of the psychological effect of being an owner for 30 years. The management team was there for a long time, and then there's the culture clash that happens. The buying company sent in a CFO from England to sit, in the corner office, and everything had to run through that person, and the owner just couldn't hack it in that environment. And
yeah, I would say that's very common, and I think 90+% of the time, someone who founded a business and is really entrepreneurial doesn't do well working for a corporate buyer. You know, one of my friends in my entrepreneurs organization forum sold a company, and then 6 months later she came to the forum and she was like, I just had my first performance review in my life and it sucked. And then the next day she quit. You know, so I think really like thinking that through is important, and sort of understanding what you want. You know, plenty of our clients keep like they're like, look, I'm not necessarily worried about whether I win the battle or not. I want to win the war. And if part of winning the war is working for this new buyer for a couple of years to have a smooth transition, like, I'll do that, but it's like eating spinach. You know, so the second thing here is tax planning. There are a lot of mistakes people make with setting up for success with taxes. And so, you know, corporate structure, are you an S Corp, an LLC, a C Corp? You know, are you going to sell the stock of your company? Are you going to sell the assets? There's trust, there's trust in a state, there's charitable giving, there's all kinds of tax planning options available. And for those of you that are like working on growing and building your business, it's not easy to grow a business and improve the margins and improve the value. It's pretty easy to sign a piece of paper that saves you money when you sell your company, and most people don't do it. And so, you know, really spending some time with good tax advisors that are familiar with exits and making sure you're set up for success there, because the difference can be, you know, very, very large. And just as an example, we had a client that we sold their company for around $70 million, and they improperly filed some corporate structure documents with the IRS, which called into question their tax status, and that issue was worth $10 million to the buyer. So had we had our client like sign the piece of paper correctly, the buyer would have paid $10 million more on a $70 million deal. Signing one piece of paper correctly was worth like years and years of work. And so like this, most people don't put the time and attention into this that they otherwise could, and it could be huge. And so, you know, a lot of us work with a CPA on an annual basis to file the tax returns and figure out how not to pay tax this year. But it's worth talking about, what do I need to be doing to be set up for success when I exit? So tax planning can make like a really big difference. Financial planning, I talked about this earlier. A lot of people don't understand, like, hey, I'm running this company. It's paying all my expenses. It pays for my car. It does this. It does that. And then tomorrow, after I sell the company, I'm going to be managing my money. And they haven't really thought through what that means, and they don't know how much money they need or what their lifestyle is going to be. And you know, there's a lot of very good resources available to do some pretty good financial planning, so people can understand how much money they need to replace the income from their business. You know, quote unquote, how much is enough? And then the fourth one is build an asset that's actually, you know, pay attention to building an asset that's actually valuable and saleable. And so that's, you know, that's kind of this number. I wanted to give you all this framework because for, you know, for someone to have a successful exit, you know, really, in my experience, all four of these things need to come into play. And none of them are particularly complicated, but they do take time and effort and awareness. And then the rest of this presentation is really kind of about number 4 here. One thing that's interesting, and I thought maybe this would be like a interesting way to remember some of this stuff, is I have a little sailboat that I race. I've had the fortune to do well in races on occasion. And what I've learned is like, there's like 100 to go win a sailboat race or a regatta or do well. There's like 100 things that have to go right. You know, it's like literally there are so many little details that all have to come together to be successful in a competition. It's very much like selling a business. And so, you know, this is a picture from Hawaii earlier this year. We shipped our boats to Hawaii and competed in the Pacific Rim Championship. And, you know, I was fortunate to finish on the podium of, you know, there's like 30 boats from all over the world. And I was fortunate to finish on the podium. And as I was reflecting on that, you know, there's like 4 things I did that put me there. You know, the first one is I did research on people that do well in that boat class and got the same equipment. So I set my boat up the same. So I had the best equipment. You know, that's doing the work up front, building your business to sell it. I was fortunate to convince this guy who has been a professional sailor his entire life and finished on the podium at the World Championship in my class to sail with me at this event in Hawaii. And I didn't even have to pay him. It was somehow I lucked out and got this like incredible teammate to sail with me. So I built a really good team, or half of a really good team in my case, and, you know, had the right, like, so putting the right team around you when you're selling your company. You know, Paul, who I sailed with, and I spent a lot of time each morning figuring out, like, this is the weather, this is like who our key competitors are, what is our strategy, for this race, and what is our strategy today. Like, we had that dialed in before we went out on the water and got into the competition. And that's like, you know, run a good process, like have a good process in mind to maximize the value of the company and find the right buyer. And then I didn't put pictures of us capsized, like swimming next to the boat, but these boats are like, this particular boat is very unstable. And of all 30 boats in this regatta, every single one of them capsized at least once, some many times. And so, you know, Paul and I did a lot of work on boat handling and controlling the boat and just making sure we had the basic blocking and tackling dialed in to, you know, stay upright. So we only capsized one time in 4 days of sailing, which was A credit to him. But, you know, like we had our ducks in a row and everything working right, and our boat handling dialed in, which is like be due diligence ready. And so, you know, have the right equipment, have the right team, have the right strategy, and execute it well. It's the same thing in selling a company. So let's see. Sounds like a Wednesday here in electronics. Okay, so in terms of value drivers, this is a checklist that I keep on my desk, and whenever I talk to a company about what would drive value for them, I have, you know, a whole series of things that I think about, and I'll go through this. I'll just go through this relatively quickly. You know, I think being aware of the industry and the market cycle is really important. A lot of industries go through consolidation, and valuations are high at the beginning of that cycle, and valuations are lower at the end of the cycle. And so if you're in an industry that's going through consolidation, it's entirely possible that multiples are higher now than they will be in 3 years, and you could grow the business and sell at a lower multiple and have less value. Or you could be riding you know, a low interest rate bubble, or a this bubble or a that bubble, and sort of being aware of, you know, being aware of and treating the company like an investment, and understanding where you are in the industry and market cycle can be important. The second one is management team. A company that has like a really good management team that a buyer can count on reduces the risk. And, you know, people pay more for an asset that has lower risk. So 2 identical companies, one that's managed by the owner who wants to cash out, and one that's managed by a professional management team that is interested in staying there and continuing to build the business under new ownership. The second one is worth quite a bit more than the first one if the companies are identical otherwise. The third one is intellectual property. A lot of businesses have a lot of intellectual property, but they haven't protected it. They haven't done patents. They haven't done copyright, trademark. They haven't marketed themselves that way. And so paying attention and really packaging the intellectual property and building it as part of your brand and being thought of as a, you know, highly desirable intellectual property based company can make a really big difference. And, you know, this can apply even to mundane industries. And so putting some thought into that really makes sense. We talked about this desired business metrics for your industry, you know, like revenue and EBITDA. If you can demonstrate operating leverage with growth, if you can sort of figure out how, you know, each year that we grow, our margins are higher, and have a formula for how you do that, that can be like a really big value driver. You can, if you have that and you have a consistent track record of that, a buyer will be comfortable looking more years into the future, and value the business higher. And then every company has, every company has other considerations, you know, whether it's growth rates, margins, proof of concept, you know, doing what you can to build predictability into a business with recurring and predictable revenue streams. And that can be contracting with customers. It can also be like working hard on a lot of your internal processes and systems to make them consistent. You know, if I track the number of meetings I have with prospects, and I know how many clients I win, and then I know what it takes to have a prospect meeting, and I've got a consistent process that's easy for someone to follow, I can go sit down with a buyer and talk about how my business runs like a clock, like a Swiss watch, as opposed to haphazard. You know, things like that are value drivers. And then, you know, being really clear on what your barriers to entry are and like why your company exists, like clear differentiation from the competition, et cetera. And so these are just some ideas to think about as far as strategies and tactics to build value in the business. And And I thought it would be interesting to maybe take a minute and do a brainstorm in the chat on value drivers. So maybe just go in the chat and type in a couple of ideas, and I think we could all look at that and maybe get some ideas from each other. Didn't know you were going to have to work on a Friday morning, huh?
You came to the right place, Channing. We have a room full of COOs, so we're born to work.
Multitasking. I got you guys all to pay attention to this one. I'm going to refill my coffee while we're typing in the chat. This is interesting. There's a couple that are not on my list. You know, I think the Connie writes having a process to capture the data. Yeah, I think what gets measured gets done. Ken wrote a number of things, but a great culture. I've seen companies measure their culture using survey tools and other things on a quarterly basis and showing that they started here and they got to here as a result of an intentional process and investment that they've put in place. Buyers love that. It's easy. It's easy to measure and come up with metrics. It's hard to, culture is intentional. Josh wrote about niche manufacturer, so certainly be related to industry position and market share. I've worked with clients that they know who their competitors are, but they don't know much about what their competitors are doing, how large they are, what their strengths and weaknesses are. They've done no industry survey stuff. There's a ton of resources available in the world today to do market research and market surveys and prove out your market position, your reputation, what your brand stands for, et cetera, et cetera, et cetera, and have that data, use it to manage the business and manage and build your brand and have that data available. Later in the presentation, we'll talk about a due diligence process, but it's common for a private equity firm buying one of our clients to spend between $200,000 and $500,000 on an industry expert doing that work to understand and validate it. And so you're at a disadvantage if you haven't done that work and you're trying to negotiate a deal with someone that spent $500,000 understanding your market position better than you do. I think Mike Quigley, the revenue labor cost for a professional services firm and efficiency in measuring and managing that. Yep. Succession plans. SaaS revenue with long-term contracts. Yeah, lots of good stuff here. Net promoter score. That's another one I think is really interesting. I've had a lot of buyers look at that. Anybody have any comments or questions before I move on? Anybody think of one for your company that you weren't thinking of an hour ago?
Channing, question on professional management team versus an owner with maybe not quite professional management team or the correct structure in place. how do you know what your buyer is going to want? I mean, some businesses may want a buyer and just want to buy the business and absorb your business into their existing management structure. Others may want to buy you with a professional management team in place and just, you know, sit on the board. Like what is there a right and wrong choice?
Well, I think in my experience, again, we're all trying to sell our company for a premium. And so in my experience, more often than not, a buyer that's buying a business and paying a premium wants to see it grow and develop. And so having a management team that knows the business, is capable of running it, and can really drive the growth in the future is kind of a key ingredient to that. And so I think it's very rare that a strategic buyer has a bunch of people sitting around like waiting for something to do. And they're like, all right, we're going to go buy this company. And, you know, Channing, you haven't been doing anything for a year and we finally found a job for you. Like, go do it. Like, that doesn't really, like, the world doesn't really work that way. And so I think having a management team and a good succession plan creates optionality when you sell. Maybe you do find a buyer that just wants the product, wants to add your products or your services or whatever to their catalog, and they don't need that many people. I mean, that definitely happens. But often that's not a premium. If you have the management team, your exit options are greater than if you don't. And I think that's kind of how I think about it. The other thing that we see is a lot of private equity firms buy middle market businesses with the idea that they'll partner with the owner to build the management team together in the future. And so a private equity firm would typically buy between 60 and 80% ownership of a company, and, you know, partner with the owner to continue to build the business and have a second sale in 3, 5, or 7 years. And over that investment period, they work together to build the management team, because, you know, the idea is they're not going to sell the owner the second time. He or she is going to retire at the second sale. And so a private equity firm can be a really nice tool to help owners continue to build out their team. And one of the things in the chat was around emotion. What I've seen time and time again with our clients is when they're able to take a very significant amount of cash out of their company, suddenly they're more comfortable trusting other people to run their business and do their job. And it becomes easier to recruit and rely on other executives. And so private equity firms coming in, giving an owner liquidity, and then being able to help recruit, identify, and bring in talented managers can make a really big difference. And so that's kind of like this private equity opportunity is kind of like a half step there. So that can work really well, if that makes sense.
Yeah, great distinction and great examples. Thank you.
Okay, so then this is another one that this is another checklist I keep on my desk. You know, a lot of people that are running companies, you know, you guys have all heard about the frog in the pot of water that, you know, gradually heats up. A lot of people running companies have, you know, a very significant risk factor with their business, but it's always been there and they're used to it and they don't recognize the risk. But, you know, businesses with a very significant risk either are not, you're either like not able to sell them, you're not able to sell them for cash, for all cash at close, or you get a discounted value. And so this is a list of things to sort of think about. With you know, engineering risk factors out of the business. You know, I think customer concentration is an interesting one. A lot of times in a small company, it's a lot easier if you have a few large customers, because you can put a lot of time, effort, and energy into taking great care of those customers, and it's a nice way to build a business. And if you can do a really good job for a large company and like sell more and more and more to them and really build your business, like that's an easy way to do it. But it's hard to sell that company because the buyer is like, all it takes is one person to wake up on a Tuesday morning and suddenly a third or half or 60% of your business goes away. And so a buyer won't take that risk. And so you either can't sell the company, or there are a lot of strings attached to the sale through earnouts and clawbacks and things like that. There are some tools you can use to deal with customer concentration. Like we sold a company that they had one of their customers was 65% of their revenue. And before we started the sale process, the CEO went to the CEO of their customer, was like, hey, I'm thinking about selling my company. Would you sign a long-term contract with me and serve as a reference? And so usually the conversation goes something like, I'm not comfortable talking to my large customer about selling the business, but I have a great relationship with them. And it's up to the new buyer to like take over and manage that relationship. And if they screw something up, that's on them. The new buyer is sitting there saying like, Channing, do you have a great relationship with the customer? Oh yeah, absolutely. Why don't you go tell them you're thinking about selling? No, I'm afraid to talk to them about that. I might lose them. Which is it? Do you have a great relationship, or are you afraid you might lose them? And so, we worked with our client to basically do it in advance, sign a long-term contract, get the guy to serve as a reference. And so when I talked to a buyer and they said, do you have a large customer? It's like, yeah, we do. We do. They just signed up. We told them we were selling. We just signed a 5-year contract with them. We're super integrated. And the CEO's name is Bob. Here's his cell phone number. If he doesn't answer, he's happy to talk to you. If he doesn't answer the call, let me know and I'll set up a meeting. The buyers were like, oh, okay, you have a really good relationship. You're integrated and you have this whole risk mitigation plan. I'm still interested in buying this company. So there are tools you can use around customer concentration, but the best thing to do is to start early in building like a diversified, less risky business. I think that some of the others on this list are self-explanatory. Employment practices. A small company can get away with cutting corners, but like Microsoft is not gonna buy a company that is cutting corners, because Microsoft doesn't want to wind up on the front page of the New York Times that they're cutting corners, because it could affect all of the rest of their business. And so like just really good hygiene around that is important. If you have ongoing litigation or a history of legal issues, that can be a problem. To the extent that you have audited financials, or at a minimum, a really good accounting team that is doing good financial reporting using accrual-based accounting. IP ownership. We had a family business that we were in the process of selling for 120 million, and they had a license agreement related to some intellectual property for their largest product that had been written in 1987 and had some back in 1987 they were done on a typewriter, and there was like handwriting in the margin that was illegible, that was initialed, and that was the only copy of the contract that was available. And it was unclear who owned the intellectual property for our client's largest product. The public company that was the buyer walked away from a $120 million deal because they just couldn't get comfortable with that risk. And this is something that our client knew was a problem since 1987, and they never addressed it over 40 years or 35 years. To prepare their company for sale, and the family still owns the company 5 years later, and they've had litigation and all kinds of problems. Sloppy processes. I think you guys are all COOs, so you get that. Reliance on key individuals. That's the same as customer concentration. If you have one salesperson that is responsible for the vast majority of your sales, you know, the buyer is going to be nervous about retaining them. IT security, compliance with industry regulations, you know, an advisory team that's not giving you good advice. Like those are all things that can screw up a deal. And so thinking about all this stuff could be pretty important as well. I think in the interest of time, I'm going to skip doing the chat on this one. And then I thought I would shift gears a little bit and just talk about, you know, like what an investment bank does and the value proposition of, you know, running a formal sale process rather than just answering the phone when a buyer calls. And, you know, what I can say is, you know, when I worked at the private equity firm and when I talk to my friends that work at private equity firms that routinely buy and sell companies, like almost 100% of the time when they sell their companies, they run a formal competitive process to maximize the value. They don't just like answer the phone from one buyer. And, you know, I think the process works and smart people use it. And so, you know, I think when you hire an investment bank and run a sale process, there's a number of things that you're doing. You know, one is creating competition to maximize value. Another one is making sure you hear from all the right buyers and understand their perspective. A third one is giving the seller a chance to interview the buyers to find the right one. You know, most companies that get sold, the owners have, you know, poured their blood, sweat, and tears into a business for decades, and they want to see it have the right home and the right legacy. So taking the time to get to know and interview multiple buyers is important. You know, the case study that I gave at the beginning, Bell Canyon, we wound up narrowing down to 3 buyers that got into a bidding war, which was really cool. And our client wound up, of the 3, selecting the offer that was the lowest cash at close, but provided a better long-term fit for the company and upside for the 2 partners that were planning to stay. And they felt like that was a better fit for their objectives than the higher price with a buyer that was going to be hard to work for. And so this process of interviewing multiple made a big difference for them. And, you know, at the end of the day, I think what we all want for the, you know, shareholder, founder, entrepreneur, owners is for them to make the best decision possible. And so running through this process, like knowing that you talk to the right buyers, you've interviewed them, you understand what the offers are, it puts you in a place when you're signing on the dotted line to make the best decision, you know, to make the best decision possible. And that's really the goal of the investment banker process. The way we do it is there's like 4 kind of pillars of success. You know, I think strategic positioning. When I worked at the private equity firm early in my career, in my first year there, we looked at 1,000 companies. And like literally, I reviewed probably 1,000 business plans. And then of the 1,000, we looked closely at 100 companies. And then I think we made offers on 5 or 6 and wound up investing in 3. And so of all these different business plans that were presented to me, one of the things I learned is like everybody does a really nice job describing what the company does. They put pretty charts and graphs together, and like the color scheme is perfect, and like they have good pictures of smiling faces and stuff like that. But rarely did anybody take the time to give me the reasons that this company was a good investment. And so a good advisor will really work closely with you to tell the story of why is this a good investment? Like, what story do I tell the buyer so they show up to the table with their big checkbook rather than their small checkbook? And so the strategic positioning is really important. You know, another one is bringing the right buyers to the table. A third one is having a disciplined process so you can create competition. You know, I sold a house and we got an offer, and my realtor was out of town for a week and didn't have time to call the other buyers to figure out what their offers were. And so I was in this weird situation where I knew a bunch of people were interested, but I only got one offer. You know, when an investment bank runs a disciplined process, we get all the buyers to show up at the same time with offers so that we maximize the chance of creating competition. And usually through the course of a process, you can see offers increase by 25 to 30% as you get people to fall in love with the business and really want it. And so getting everybody to show up at the same place and the same time with their offer is important. And then the final pillar is like the people on our team have a ton of experience telling the story and getting buyers excited. And when you put all four of those things together, those are the ingredients to a successful transaction. And then, you know, in terms of the actual process, you know, it's a 6 to 9 month process. And, you know, we do the preparation phase up front where we put the materials together. You know, we go and market the business and then ask for offers and then work through due diligence and close. And there's a number of things that we do at each step that can make a really big difference. And so as you're thinking through the process, there's a lot of the devil is in the details at each stage. One of the things here that I really like that we do that I think is worth getting you guys to think about is in the second column, the post-acquisition economics. We spend a lot of time thinking about, you know, when we call the buyer, you know, how are they going to create value from this investment or from this sale? And how do we get them feeling like they're going to create more value so they can share it with our client? And so we spend a lot of time with them on, yeah, I know the business makes like X dollars today, but when you own it, you can do these 4 things and, you know, double the income. And that's going to be massive for you. So share part of the gain with us. And we explicitly have those discussions and we think it through. You know, one of the things you guys can do in the ordinary course of running the business is like, think about who are the buyers for the business? What are they going to do with it? And how do I put the pieces in place today to make it easier for them? And so that's like a really big thing that I think a lot of executive and business owners are not necessarily thinking about. And then, you know, the last thing that I wanted to leave you with is buyers come in and do due diligence, and it's like excruciatingly painful. On a $70 million deal, I've seen buyers spend $3 million on due diligence. I think most people on this call couldn't figure out how to spend $3 million. Couldn't figure out how to spend $3 million on due diligence, but like literally a buyer will know your business as well as you do before they write you a check when they sell it. And they scrutinize the budget and the financial projections, you know, 7 ways to Sunday. And so, you know, getting used to having a really good budget and a really good handle on how to build financial projections. One of the people put in the comments, zero-based budgeting. That's a really valuable tool. And we've done that with some of our clients to help them beef up their budgets. And so, you know, a buyer will spend weeks and weeks and weeks combing through financials, combing through operating metrics, and really getting comfortable with the financial projections. The second one is they'll bring an accounting firm in to do what's called a quality of earnings, and they'll validate that the financial statements and the earnings are what we said they are. And so, you know, if you have not been doing audited financial statements and you don't have a good CFO and accounting group that's doing GAAP financials, a quality of earnings firm comes in and scrutinizes everything. And like literally their job is to find ways to beat you down in due diligence. And they're good at it. And there are professional teams at the largest accounting firms in the world It's the only thing they do is come and look for problems with accounting. And then, there's legal. Every contract you have, every employment agreement, every single thing you have, even the copy or lease will get reviewed. And so having that stuff all available, trying to minimize having weird things or approvals needed can make a transaction easier. So legal's big. Tax. Buyers get really concerned that you've paid all of your taxes correctly. And there's taxes due that you've never even heard of. There's sales tax, use tax, transfer tax, state, local, federal, et cetera, et cetera, et cetera. And a lot of times, there's employer taxes. A lot of times these taxes and the liability associated with them transfer to the buyer irrespective of what the legal agreement says. And so buyers get really nervous about a company that's been sloppy or hasn't paid tax correctly, because it can create future liability for them. And so there's a lot of time and effort spent on tax. Employment practices, human resources, culture. I've seen buyers come in and do very significant work on all of those things to make sure it's right. Making sure the company has been properly insured. Technology and intellectual property. For companies that have technology or software, buyers will come in and do penetration testing. They'll review software code. They'll review patents. They'll do a ton of research on that. In companies that are regulated, they'll come in and look at all the regulatory frameworks and look for issues with that. And part of this due diligence process is to make sure they understand the asset they're buying. And part of it is, they've signed the letter of intent with you with a certain price in it, and now they're looking for ways to reduce the price. And so the more you can be ready for this and have your ducks in a row in every single one of these areas, the less chance there is to have a disappointment along the way. And again, the buyers spend hundreds of thousands of dollars or millions hiring the very best people to look at each of these things. And it's their job, it's their only job. They do it every day. So as a seller, if you haven't if you don't have your own advisors and you haven't really put time into making sure you're buttoned up in each of these areas, there are risks. And so I think that's a big part of being ready to sell. That's pretty much all my slides. I think there's a few minutes left to open up for questions.
So what's the typical look back period for financials, taxes, litigation, past litigation, obviously pending litigation? Is it 3 years, 7 years?
I think I think a lot of times they're looking at the statute of limitations. So for taxes, I think that it's typically 5 years. For taxes, I think it's typically 5 years. For financials, typically a buyer will scrutinize 2 to 3 years of past financials. And then for other regulatory and other things, I think it really is situation specific.
So for past litigations, how long is that? Just is that pervasive?
Yeah, I mean, that one's pretty pervasive, but I think they'll usually ask for they'll usually ask for since inception of the company, but they'll pay closer attention to, the last 5 years typically.
That makes sense.
Yeah.
Yeah. When I was with my startup in San Francisco, this was more or less our table of contents for our data room. Yeah. And when we got bought out, when we raised our Series C with TPG, Testament, it was a colonoscopy. It was long. It was hard.
Without drugs. Yeah.
No, without drugs. Yes.
Yeah.
We're not sedated.
With caffeine. Yeah. On caffeine. Yeah.
So under the business and financial projections, what I would kind of keep a sub bracket under, they were very focused on our deployment cycle. We were dealing, and then I think this is industry specific, but because we were dealing with government contracts, and there were long contracts, and it was a hardware and a software play. So the hardware was sticky, so it was hard. It was a long deployment cycle. And they were also extremely focused on the sales cycle, which was painfully long, 4, 5, 6 years, with some of our sales cycle went beyond the inception of the company because the relationships started from previous lives.
It's interesting that you're bringing that up. I think like every company has like I would call it a customer journey. I did this information, I got a lead, the customer signed up, and then I like did all these things for the customer, and then they left. And at every and I think we spend a lot of time like, how do I take and understand this customer journey and then map that back into a financial model so that I can build predictability into the business. I think that's like a really interesting exercise in a lot of like services businesses where I spend a lot of time. We'll look at the number of leads each month, the value of the leads, what the sales pipeline was, what the conversion rate is, and then we can model out where the sales pipeline is going based on our sales activities. And then if you know where the sales pipeline is going and you can use average conversion rates, then you can predict revenue. And we really like try to build up from the bottom up what the projections are. And then when you sit down with a buyer, you can explain the unit economics of the business really well. Like most of you guys already know the unit economics for your business because you like eat, sleep, and breathe it every day, but it's hard when you have to sit down and communicate that to an outsider. And so like really mapping out, like Connie said, the customer journey, mapping that back to the financials can be a really helpful tool.
And it also it can get extremely political because now operations is getting into the sales cycle. And if you don't have a very transparent sales cycle process, be prepared for that. When I was mapping out the deployment cycle, I started at the shake hands with a customer at a conference and says, "Oh yeah, let's do a demo," all the way down. So it was very, very intense conversations with my growth officer.
Give Channing a round of applause. Thank you.
Yeah.
I think we've all just increased our businesses at least $10 million. So I don't know, do we send you, we'll send you out instructions on sending Channing a check to today's call. But thank you. And thank you, Channing and Kathy as well for helping to set this up, and Fiona. It's so wonderful to have you on. I learned a ton, which I'm appreciative of, and I hope everyone else on the call has as well. Before we sign off, just to we have Randy Franklin. Is Randy still on the call? We have Randy lined up.
I'm here.
Yeah, he's going to be our next month presenter on going from a COO role to a sales role and back to a COO, and all of the fun he learned in that sales seat. And as we say, we're always in the role of sales, regardless of our title. So I'm really looking forward to having Randy on next month, and I know he's looking forward to it as well.
Definitely. Thank you.
That's Friday, I think December the 12th, if I'm not mistaken. We've got our executive session coming up on the 19th with Josh, year-end review and planning for 2026. So sharpen your pencils and be prepared for that great discussion. But I just want to thank all of you again for taking time off to work on yourself on a Friday. I'm super appreciative of seeing everyone on the call, and thank you again, Channing. Anyone with a final word? We ready to get out here and get on with the rest of our day and our weekends?
This was very informative. Thank you.
Right.
Thank you. And again, I'm happy to help. So feel free to reach out.
Absolutely. Yeah, we appreciate that offer. And again, so round of applause. Thank you all, and have a wonderful weekend.